Harry thought he was investing, until he lost half his net worth in 6 months. Meme stocks, crypto, AI plays, all gone. What he didn't know? He'd fallen for the same trap that wipes out millions of retirement accounts every decade. There's one question, just one, that instantly reveals whether you're building real wealth or gambling your future away. Benjamin Graham used it, Warren Buffett swears by it, and by the end of this video, you'll be using it too. I'm about to share Graham's 10-year test that instantly reveals whether you're building wealth or just playing the world's most expensive lottery. You'll meet Harry, an everyday investor who thought he was doing everything right until this one question changed his entire approach to financial planning. Here's exactly what we'll cover. First, I'll show you the psychological trap that's destroying most people's retirement savings without them realizing it. Then, you'll discover the exact question Benjamin Graham used to separate real investing from dangerous speculation. Next, we'll follow Harry's complete transformation from emotional gambler to disciplined wealth builder. And finally, I'll give you the step-by-step system to apply this test to your own investment portfolio starting today. By the end of this video, you'll know exactly which side of this line you're on, and more importantly, how to get on the right side if you're not already there. This video is for informational and educational purposes only. It is not financial advice. Let me tell you about Harry. 2 years ago, Harry was convinced he was a brilliant investor. His investment portfolio was filled with hot tech stocks, meme stocks, and whatever was trending on social media. When Tesla shot up 50% in a month, Harry felt like a genius. When his cryptocurrency doubled overnight, he started planning his early retirement. But here's what Harry didn't realize. He wasn't investing. He was speculating. And there's a massive difference that most people never understand. Benjamin Graham, Warren Buffett's mentor and the author of The Intelligent Investor, put it perfectly. An investor calculates what a stock is worth based on the value of its businesses. A speculator gambles that a stock will go up in price because somebody else will pay even more for it. Harry was doing exactly what Graham warned against. He was basing his standards of value on the market price instead of establishing standards of value independent of the market price. Every morning, Harry would check his phone obsessively, watching those green and red numbers dance across his screen. When stocks went up, he felt rich. When they went down, he felt poor. The problem? Harry's emotions were completely tied to price movements he couldn't control or predict. He was like a person standing in a casino, calling himself a businessman while pulling the lever on a slot machine. And then came the crash of 2022. Harry watched in horror as his brilliant picks got cut in half, then in half again. The meme stocks? Down 80%. The hot tech darlings? Devastated. Harry realized he had been playing the most dangerous game in the world, trying to beat professional speculators at their own game. That's when Harry discovered Benjamin Graham's life-changing question, what I call the 10-year test. Graham asked, "Would you be willing to own this investment if the stock market closed for 10 years?" Think about that for a moment. If you couldn't check the price, couldn't see those daily green and red numbers, couldn't sell tomorrow if you got scared, would you still want to own what you own? When Harry first heard this question, his stomach dropped. The honest answer was a resounding no. He realized he didn't even know what most of his companies actually did. He couldn't tell you their revenue, their profits, or whether their businesses were growing or shrinking. All he knew was that other people were buying them, so the prices were going up. This is the brutal truth the 10-year test reveals. If you can't confidently answer yes to this question, you're not investing. You're speculating. Real investors think like business owners. When you buy a piece of a company, which is exactly what a stock is, you should want to own that piece of the business for the long haul. You should believe in the company's ability to generate passive income streams through profits, even if no one else ever wanted to buy your shares again. Speculators, on the other hand, are just betting on price movements. They're hoping to find the greater fool who will pay more tomorrow for something they bought today. It's the financial equivalent of musical chairs, fun while the music plays, but devastating when it stops. If this helped you rethink your strategy, give it a like. After the 10-year test opened Harry's eyes, he completely changed his approach. Instead of chasing hot stocks, he started asking different questions. What does this company actually do? Are they profitable? Do they have a sustainable competitive advantage? Would I want to own this business if I could never sell it? Harry started focusing on investment research instead of tips from social media. He learned about companies with strong brands, reliable dividend growth, and businesses so essential that they'd probably still be around in 2034. Let me show you the difference between these two mindsets. The old speculator Harry would think, Tesla is up 20% this week. Everyone's talking about it. I better buy before it goes even higher. He was focused on price action, momentum, and what other people were doing. The new investor Harry thinks completely differently. I want to own a piece of a company that will be worth more in 10 years because the business itself will be more valuable. Let me study companies that have durable competitive advantages, strong management, and growing profits. The difference is night and day. Speculator Harry is playing a guessing game about psychology and market timing. Investor Harry is making calculated decisions about business value. Here's what happened to Harry's investment strategy after he embraced the 10-year test. Instead of buying individual stocks he didn't understand, he started with a foundation of broad market index funds, owning pieces of thousands of profitable companies. He applied dollar-cost averaging to build his position systematically, buying more shares when prices were low and fewer when prices were high. For his individual stock picks, Harry now only bought companies he could confidently explain to his grandmother. Companies with simple business models, strong competitive positions, and track records of growing their intrinsic value over time. The psychology behind the test. Why does the 10-year test work so powerfully? Because it forces you to separate two completely different mental activities: investing and speculating. When you're speculating, your brain is constantly trying to predict what other people will do. Will they buy more Tesla tomorrow? Will crypto go back up? Will the meme stock crowd discover this unknown company? It's exhausting because you're trying to predict human psychology, something that's essentially unpredictable. But when you're thinking like a 10-year owner, your brain shifts into a completely different mode. Now you're analyzing business fundamentals. You're asking, will more people want Coca-Cola 10 years from now? Will Microsoft's software still be essential to businesses? Will Johnson & Johnson still be selling healthcare products to an aging population? These business-focused questions have much more predictable answers than psychology-based questions. The 10-year test also eliminates what Graham called quotational values, your obsession with daily price movements. When you're thinking about 10-year ownership, those daily fluctuations become irrelevant noise instead of emotional triggers. Think about it this way. If you owned a local business, let's say a profitable restaurant, would you check its value every day based on what random people on the street said they'd pay for it? Of course not. You'd focus on whether the restaurant was serving good food, attracting loyal customers, and generating consistent profits. That's exactly how real investors think about their stock positions. They're not worried about what Mr. Market, Graham's famous metaphor for the emotional bipolar stock market, thinks their shares are worth on any given Tuesday. They care about whether the underlying businesses are becoming more valuable over time. This shift in thinking is incredibly liberating. Instead of being stressed about daily market movements, you start feeling like what you actually are: a part owner of profitable businesses, building wealth through compound interest and business growth. Here's how to apply the 10-year test to your own financial planning. First, go through your current holdings and ask yourself honestly, if the stock market closed tomorrow and didn't reopen for a decade, would I be happy owning these investments? If the answer is no, you've identified positions that are speculative bets rather than true investments. This doesn't mean you have to sell everything immediately, but it means you should start shifting toward investments that pass the test. Second, before making any new purchase, ask the 10-year question. If you can't enthusiastically answer yes, don't buy it. This simple filter will save you from countless investing mistakes. Third, focus on building a foundation of investments that easily pass the test. Broad market index funds are perfect examples. They give you ownership stakes in hundreds or thousands of profitable companies. You're essentially betting that human innovation, productivity, and business creation will continue over the next decade. That's a bet with over 100 years of evidence supporting it. For individual stocks, look for companies with what Warren Buffett calls economic moats, competitive advantages that are hard for competitors to cross. Think about brands like Apple, customer loyalty like Amazon's, or essential services like utilities. These are businesses you can confidently imagine still being valuable and profitable in 2035. Remember, the goal isn't to find the next big winner that will triple in 6 months. The goal is to own pieces of businesses that will compound your wealth steadily over time, regardless of market mood swings. When you start thinking this way, investing becomes much simpler and less stressful. You're not trying to time the market or predict the unpredictable. You're simply asking, do I want to be a part owner of this business for the long haul? Harry's transformation from speculator to investor didn't happen overnight, but the 10-year test was his turning point. Today, Harry sleeps well at night because he owns pieces of businesses he understands and believes in. He's not worried about tomorrow's headlines or next week's market movements. The bottom line is this: real investing isn't about predicting price movements or finding the next hot stock. It's about becoming a business owner who thinks in decades, not days. When you pass the 10-year test, you stop being a victim of market emotions and start being a builder of financial independence.